So this chapter is all about an introduction to investing. Here, I'm going to walk you through the basics of what is a stock, how to buy a stock, and how you can build your wealth with stocks. So first, I will go through a definition and purpose of a stock. So a stock represents ownership in a company. So let's dive a little deeper into what it means when we say that a stock represents ownership in a company. So I want you to imagine you have your favorite pizza, pineapple pizza, and you decide to share it with your friends. So each friend gets a slice of the pizza. So the same concept applies to stocks and companies. When you buy a stock, you're buying a small piece, a small slice of that company. Just like each slice of a pizza represents a whole portion of the pizza, owning a share of stock means you have a portion of the company. So let me give you a written example onto what it means. So I'm going to take my pen. So let's say you have company A, and company A's value is the total value of the entire company. So the entire slice, entire pizza is, let's say, 1,000. So company A wants to sell 10 shares. So company A wants to sell 10 shares. So that means cutting up this. So I want you to imagine that this company A, it's like a big piece of pizza. And 10 shares means 10 slices, which means that each slice is worth $100. So that's how stocks work. You add up all 10 shares, each $100, you get the entire price of the company. So by buying stocks, you can become part owner of the company. So it's like having a say in how the company operates and grows. And that brings us to the purpose of stocks. So companies often need money to expand their business. Because let's say if I start a company, my own company, and I make it public, I want to sell more products. However, I have not enough capital, um, and that's why I need to get money to expand. So this money is mainly used to hire more employees, develop new products, invest in new technologies. Um, yeah, but as I said, they can't always do it alone, these companies. So they offer the stocks to the public. So when you buy those stocks, the company receives the money, uh, which they can which they can then use to fund the operations and grow their business. But you might be wondering, what do you get in return? So let's say you buy a stock, the company gets the money, but what do you get in return? So when you own a stock in a company, you have certain rights as a shareholder. So when you buy a stock, you're called a public limited company stock, you're called a shareholder. So one of those rights is the ability to vote on important matters related to the company. So companies often have shareholder meetings where shareholders get to vote on decisions like electing like the board of directors or approving major business moves. So as a shareholder, you have a say in the company's direction and decision making process. So owning stocks gives you the opportunity to participate in this decision making process of the company. It's like being part of a team that helps to shape the future of the business. So your vote, so you own one slice of the pizza along with the rest of the votes. So the other people that own the other 9 slices can actually influence the direction and success of the company. So another important aspect of owning stocks is receiving a portion of the company's profits through dividends. So when a company, let's say the company sells toothpaste, and it managed to sell a lot of toothpaste and it makes a profit, and so to repay its shareholders, this company will give back a portion of the company profits, which are known as dividends. So again, this is a company choice. So when a company makes money, it can choose to share some of the earnings with its shareholders. So you might wonder, how does it work exactly? So this like what's the purpose of this dividend payment? So these dividend payments are like a thank you. So you invest in them. This is like thank you. You invested in me, and this is the return that I want to give you. So the amount of dividend you receive is determined by number of shares you own. So for example, if the company declares a dividend of $1 per share and you have 100 shares, you would receive $100 as a dividend payment. However, it's important to note that, just reiterating, not all companies pay dividends. So some companies, why they don't pay dividends is because they might reinvest their profits back in the business to fuel growth and expansion. So if a company doesn't pay dividends, investors can still benefit in other ways. So one potential benefit is the increase in stock value over time. So the company performs well. So let's say it performs well, it gets its profits, it invests back, it gets bigger, it sells more, and its stock's value will increase. And why is that good for you? Because if the stock value increase, you can sell your stock for a higher price, and that's how you make a profit. So next, I will go through some very basic concepts which I want you to familiarize with. So the first one is stock market. So the stock market is a place where stocks are bought and sold. So it's like a common marketplace. Like any marketplace, people are there to sell, people are there to buy. So stock market here serves as a platform for investors to trade stocks. Um, so again, the stock market is like a marketplace where stocks are bought and sold. It's a place where investors come together to trade stocks, just like people come together at a mall or market to buy or sell different things. So unlike a normal market where it's mostly physical, here the trading takes place on stock exchanges. So these are organizations or platforms that provide a regulated marketplace for trading stocks. So you have like eBay, Amazon who sells products. Here we have stock markets. For example, the New York Stock Exchange, the Nasdaq, the London Stock Exchange, the Tokyo Stock Exchange. So these are like marketplaces for people to exchange stocks. So how does the stock market work? So in the stock market, buyers and sellers of stocks come together to make transactions. So investors like individuals, institutions, or even other companies who are interested in buying or selling stocks can all participate in the stock market. So it's not exclusive to, it's mostly not exclusive to anyone. So they can place orders to buy or sell shares of different companies. Stock. So what determines the stock price is determined by the interaction between buyers and sellers. So it's all about supply and demand. When there's a high demand for a particular stock, like because people think that this company is going to do well or is making a lot of profits, the stock price will go up. Um, Conversely, if people think there are more people wanting to sell the stock for various reasons, for example, its profits are dwindling, there's a legal action against it, people just want to get rid of it, then the stock price will go down. So in the stock market, each publicly traded company is assigned a unique ticker symbol. So the next thing I'll go through is ticker symbol. So a ticker symbol is a series of letters and sometimes numbers that represent a specific company's stock. So it's used to identify and differentiate companies in the stock market. So it's something you could call a very unique name uh, to identify each company. So each publicly traded stock has its own unique ticker symbol. So these symbols are often abbreviated versions of the company. So for example, the ticker symbol of Apple is AAPL, short form for Apple, or Microsoft is MSFT. So these ticker symbols are used by investors, traders, and financial professionals to identify and track the stock of these specific companies. And when you search for stocks online, you always want it's better to also use these ticker symbols because all these stock exchanges refer to these stocks by their ticker symbols. Stock prices also fluctuate based on supply and demand. So if you look at this chart in the short term, you can see in this chart, this is the Google share price, and this entire period you see here is between 13 April and 9 May is a one. It's about roughly a 1 month period. So the prices in the short term can be very irrational. So in this chart, you can see it's about the high is about 110, the low is about 105, 104. That's about 10%. So other businesses might be even more irrational. So for example, some stocks can go up 20, 50% within 1 month. So let's say you put in $100, then the next month you could be down 50% and you have 50. So in the short term, prices fluctuate a lot. So we always strive to invest in the long term to basically avoid this issue here because the buying and selling short term that you see is mainly dominated by emotions from various traders, mainly fear and greed. So this is the exact same chart, but again Google. But the only difference here is that instead of 1 month, it's over a 10-year period. So again, if you look at the short term, you can see a lot of tiny, tiny bumps there. And it might go up, it might go down. So even though short term, it fluctuates up and down by 10%, we have seen previously, but long term, stock of a good company will always keep increasing. So what affects stock prices in the long term? So several factors influence stock prices in the long term. Firstly, the financial performance of the company plays a significant role. So, so for example, positive factors like a company making more revenues, making more profits, strong growth prospects can lead to higher stock prices for the company. Um, on the opposite end, poor financial performance or negative news about a company can cause the stock price to decline. So besides these company specific factors like its profits and all, there are also other factors. So this could be industry trends. So how does industry trend affect stock prices? So positive trends such as an increased demand for a product or service can drive stock prices higher for companies in that industry. And negative trends or disruptions can have a negative impact. So you might ask, there are so many factors that affect the company. How can we accurately determine whether the share price of a company will go up or go down? So I'll teach you more about this later on. For now, just know that even though stock prices can go up and down um, in the short term, but historically, for good business, the markets tend to recover and grow over time. This is especially true, again, for great businesses. So its share price is low due to fluctuations, but long term, a great company will rise.